The markets, to me, have felt like you're on a boat and the waves are just getting bigger and bigger. And the flows, I think, reflect that, and the ETF performance does as well. Interestingly, $13 billion into ETFs over the past week is probably shocking to some people, but you got to remember, ETFs offer things that you would run to when you're feeling scared. So a lot of those are those flows. The Qs at the top is unusual, but that goes to the rocking waves because we'll have a huge, like 7% down day, but then a 5% up day. Some of these flows are the catching on the up day, but largely the trading crowd has been bailing. Look, you've got short-term treasuries, Vanguard as usual, short-term treasuries, gold. So mostly it's safe haven in. Let's look at the outflows, and you're going to see what you'd expect. A lot of junk bond action. Junk bond ETFs been getting hit pretty hard lately. There's financials. You've got small caps, S&P, emerging markets, the usual. But largely, again, mostly not much on the out compared to the in. Let's look at our two proprietary indexes that track risk-on type ETFs, both factors, sectors, and bonds, and risk-off type ETFs, which have the reverse, right? So these are going to show you a very clear thing. Risk-off is really winning. Risk-on is barely petered down to nothing, but look how big risk-off is compared to any other time over the past couple of weeks. So Scarlet, ETFs are definitely positive net flows, but you look in there, largely it is a move to risk off.
All right, and risk off, of course, gold, a big component of that. So we want to bring in George Milling-Stanley. He is Chief Gold Strategist at State Street Global Advisors. We also want to welcome Vildana Hajric of Bloomberg News. George, let me start with you. Gold getting a boost from the stampede out of risk. But what surprises me is that gold isn't up even more. It rose above $1,700 an ounce, but it's still shy about $100 of its record high in October of 2012. What's holding gold back?
I think, take the slightly longer picture. Last summer, gold broke out of a trading range which had capped the price at $1,350. We're $300 above that right now. So I don't think it's really fair to say that something is holding gold back. The other thing to say is coronavirus is obviously the new thing on the block and is going to have an impact, no question about that. But gold was already above $1,600 before corona came along. What I think is, if anything is holding gold back, it's the fact we keep getting these sudden sell-offs in stocks. People had bought stocks on margin. They don't want to sell the stocks at depressed prices. They sell gold in order to meet margin calls. And as soon as they're out of the woods and the stocks recover a little, then they'll buy back the gold. And that's what we've seen. We saw it we saw it a couple of weeks ago. We saw it at the end of 2018. We saw it in 2008.
Okay, Vildana, let me bring you into the conversation. You're on the front lines. You're tallying up the damage on the risk side. What are you hearing? What are people saying?
In speaking with investors over the last couple of weeks, there's definitely been this recurring theme that investors simply don't know what's going on. When you have a 7% down day followed by a 5% up day, it's really hard for them to game and figure out how the coronavirus might impact the economy and the stock market. But there's definitely been this stampede away from riskier assets. So if we take a look at HYG, for example, on Tuesday, it saw a $1.5 billion outflow. Last week, at one point, we saw a $4 billion outflow. So these are sums that you might see in a week or in a month, but not in a single session.
Now, George, we think of gold as a safe haven when we're tracking markets, but a lot of the demand is jewelry. And you would think that might be suppressed given what's going on. Is that pulling away from the safe haven? How does that break down in terms of the market share of those two and the current demand of those two?
Sure. I mean, jewelry is very important. It's anywhere from 50 to 60% of each year's consumption. China's the biggest consumer. China is hardest hit by coronavirus. So there's obviously going to be some impact there. But there is an offsetting mechanism in gold, which is that when people are worried about things, when people are frightened, then they buy gold as a safe haven. So that investment demand, which is typically 20 to 30% each year, tends to go up when jewelry demand is going down. So it's kind of an offsetting thing.
Remember when Bitcoin was supposed to be the new gold, a safe haven or an uncorrelated asset? Vildana, Bitcoin has fallen along with everything else lately.
It has. And so for weeks, for months, we've been hearing this argument that Bitcoin is a safe haven play because back in January, when tensions between the U.S. and Iran were rising, for example, we saw the price of Bitcoin rising. And so investors were making the case that it's a safe haven play. But we've really seen that argument break down over the last couple of days. It's fallen along with everything else. So what one investor told me is, in times of stress, cash is king, and so it makes sense that a lot of people are selling out of cryptocurrencies as well.
George, I'm just going to let you spike the football real quick. I know this. Go ahead. What do you got to say about Bitcoin not holding up in this as a safe haven?
I think that the volatility in Bitcoin being several hundred times the volatility in gold, I think that kind of devalues anything that people could talk about as a strategic asset.
if you even want to call it an asset for some people.
Well, there's that too. I think of it more as a casino chip, right?
All right, Vildana, I want to bring you in again on some other themes that captured our attention. Monday was pretty manic because you had the coronavirus. And then on top of that, you had oil in free fall because of the price war between Saudi Arabia and Russia, as well as U.S. shale producers. How did that show up in ETF action?
So it's definitely been a major theme this week. We saw the price of oil crashing 20-30% on Monday. And so what investors have been doing is focusing on these leveraged oil products. We all remember what happened with XIV back in 2018. So the spotlight has been on funds like Gush and UWT. UWT fell 70% on Monday. We saw Gush drop more than 80% on Monday. And we actually had two Wisdom Tree funds in Europe that were shuttered.
Yeah, it was pretty wild. George, in terms of volume, obviously GLD and all ETFs see spikes of volume in these stressful times. Talk to us from inside the gold world, how GLD is viewed, how much of it market share does it make up, and especially during these stressful events?
Okay, in normal times, GLD is typically about 1% of total turnover in the whole global gold market, which is around about the $150, $200 billion a day mark on average. But recently we've seen turnover in GLD spike up to $5 and even $6 billion in a day. So I think that the liquidity that GLD provides is really what has come to the aid of investors.
And just real quick, we talk gold is zero correlated, whereas treasuries are inverse. They almost guaranteed to go up when stocks go down. Can you admit that gold may not go up when stocks go down all the time?
Oh, I think that there are always times when, like we've seen recently, when people are meeting margin calls on equities, then gold will go down. But I think typically it has tended to recover much faster than stocks, much faster than anything else that you could call a safe haven.